What's going on, guys? Welcome to the Hustle or Stay Basic channel, the Invest or Stay Basic segment. I'm your host at KG the Hustler. I hope you're all doing well today, enjoying the beautiful weather. Actually, I had to close all my shades here because it's so sunny here in Canada. Hope you're staying safe. And, with good weather comes bars, restaurants, and due to this pandemic, we're not able to technically enjoy all of that. But with a recovery plan in play, it's time to look at some recovery stocks, one of them being Boston Pizza Income Fund. This is actually a KG pick stock. Every week I'm going to drop one episode of my pick, like a stock that I'm looking at, one episode of something that you may have commented on that you want me to take a look at, and one episode of the Hustle or Stay Basic podcast where I have interviews with freelance and entrepreneurs and try to learn from them how they started their business or how they navigated through their non-linear journey. Okay, with that all said, let's go take a look at the company. So as I mentioned, I am taking a look at Boston Pizza Royalties Income Fund, ticker symbol BPF-UN. Has a market cap of $284 million at the time of this recording. Kind of looking at it because I think it might be a dine-in restaurant recovery play. A couple things to note is it is down 30% over the last 5 years. I mean, it is up over 100% on the year, but a year ago we were in a stock market crash, so that's not saying too much. A couple other things to note is it has solid dividends, actually paying out 5.9% forward yield, which is absolutely great. And it's a royalties income fund, which I've spoken about a bit in a previous video, but I will give you a quick refresher. Before I get into what the company does, I just want to give a shout out to anyone who bought the dip. If you got this stock at $6, $7, $8 a share, congrats. I mean, you're set for 10% yield for a long time. So congrats on that. Now let's go take a look at what the company does. So if you're not familiar with what Boston Pizza is, it's a restaurant brand. They're kind of in between fast food and formal restaurants or formal dine-in. You go there to grab a beer with the boys, watch some sports, meet up with some friends. I mean, it's everything that you couldn't do during this pandemic. And a lot of people are looking at this company as a huge recovery play. There's a blurb here also that says they have 387 restaurants across Canada. So cool. That makes sense about Boston Pizza, but let's give you a quick refresher on what a royalty income fund is. So like I said, I mentioned this in my video, my favorite stock to own, which was A&W. And basically a royalty revenue income fund is a top line sales fund. When you're buying this, you're not buying all the restaurants that Boston Pizza owns. You're just buying the royalty. Luckily for you, the royalties are 4%. So essentially all the Boston Pizza franchises are skimmed at 4% royalty for using the Boston Pizza name. And they're distributed to you as a shareholder monthly, which is totally awesome. All right, let's go take a quick look at how their sales have been growing, if they've been growing. And not really, pretty stagnant over the past 3 years. I mean, this is the pandemic that they face. And you know what? Actually, not too bad for the pandemic. Mind you, this is 4% of the sales. This isn't all the sales. I'll get into the deeper details on that a little bit later. But unlike A&W, which I did a video on a couple months ago, I think, you'd love to see a little bit more growth. I mean, A&W, you can kind of see like a kind of straight trajectory. Whereas this is not that great. Let's go take a look at why this is an outlier and the impact of COVID-19 on Boston Pizza. So what I want to focus on this slide is the franchise sales reported by the restaurants in the royalty pool. I mean, that's where you're getting your distributions from. Look at that. We had $855 million in 2018, $853 in 2019, and $613 in 2020. Absolutely devastated. And mind you, they're growing. They had more restaurants. Now I have a little slash on here because in the previous slide you saw that I mentioned they had 387 restaurants. I mean, on their annual report they said they had 395, but I think we know that they have 387 restaurants. Look at the impact of COVID-19. They actually had to shut down 11 restaurants. But what's interesting is even without COVID-19, they were still shutting down restaurants, which kind of, it doesn't make you feel too great about the brand. So I have a little blurb here about SRS, which is same restaurant sales. And why that's important is because it kind of gives you an idea of how the existing restaurants are doing. So for example, if I had 10 restaurants and I was doing $100 million worth of sales, and then I had 15 restaurants and I was doing $150 million worth of sales, you want to know, hey, is that 150 attributed to just those new restaurants being added, or are existing restaurants growing as well? Unfortunately, this metric doesn't look too good for Boston Pizza. As you can see, same restaurant sales are not growing or didn't grow much in 2018 by 0.1%. They were down in 2019 and absolutely devastated in 2020 by 30% almost. But hey, we're in 2021, we're going to recover, it's going to be awesome. Well, for January 2021, it's not great as well. It was negative 49.5% when compared to the same period in 2020. So not a great start for 2021 either. Okay, so I've shared some, pretty bad news. Let's go to a slide that kind of shares the main reason you own this stock, and that is the distributions. So as I mentioned earlier, distributions are monthly, and you get about 6.5 cents per share a month. And that's what they've been doing thus far. If you owned about, $20,000 of shares, you'd be getting $100 a month from this income fund. What's great about income funds like these are if you reinvest that, $100 and kept on buying shares, by the end of the year, you'd have 84 extra shares. And over a long period of time, that can compound pretty quickly, and your monthly dividends will increase as well. So it literally pays to be a long-term investor. Okay, we got that out of the way. 6.5 cents is not bad, but historically they've actually given more distributions. And I got this little chart here to show that. So obviously due to the pandemic, they had only $16.3 million of distributable cash. But in 2019, 2018, they had quite a bit, almost 11 cents per share per month, or $1.38 per year per share. So those are really great numbers. And I know people holding the stock today are hoping and wishing that we get to that number, and I think that's why it could be such a good recovery play. But I think before you even just jump in and say, hey, this is an awesome recovery play, I'm definitely going to make some good money on it, I think we do need to take a look at the valuation that we have today and whether it makes sense to jump in. So the essence of this stock is basically based on cash flow. So why not look at the price to cash flow ratio to get a better idea of whether this stock is either undervalued or overvalued today? So based on that metric, the price to cash flow is actually really high right now, and it's based on investors thinking the cash flow will catch up in 2021. Personally, I think if you were able to get the stock at 8.5, that's a really good margin of safety. If you look at this 5-year trend, it kind of bottoms down at the 8 area. So if you're able to get it there, that's a good deal. Anything below is just a smoking hot deal. So congrats to any investors who got in at that point. But it does look pretty high right now, and there is a lot of speculation built into this that cash flows will catch up. Second metric I have here is the price to book ratio, and it's basically at 2020 highs, and I think that's basically factoring in a perfect recovery, and I think that's a little bit optimistic, and I'll share my final thoughts on that. So key things to know is there is about 1% less shares available out there, but also note that there is about 2% less restaurants due to those closures. So keep that in mind. Forward P of 10 sounds awesome, but it also sounds optimistic. Remember, this is based on analyst forecasts. The dividend still looks juicy. 6% is just sweet. And, if it ever does return to that 11.5 cent mark, we're looking at 10% annual yield. If we're being conservative and saying, hey, there's not a full recovery, you're still looking at something around a 7% yield, which is awesome. But personally, I'm still cautious. I think the current valuation is factoring in a perfect recovery. And, there's a lot of things in the economy showing that it might not be a perfect recovery. For example, Canada's top doctor says variants are threatening progress made against COVID-19. There's still risk that something else happens and, all these locations aren't able to open up fully like people are planning that it should. I think at, $13 a share, it's still a little bit rich. I'll be looking to buy around the $10 to $11 per share range. Just just because you gotta weigh the risks and the rewards. And personally, I think there's more risk than reward at this point. That's why I'm looking at the $10 to $11 range. So I hope the stock drops a bit. I mean, I really like Boston Pizza. I can't wait to hang out with my friends, have some beers, have some drinks, watch some sports. But unfortunately, we can't. And this stock is, valued like we are going to do that very shortly. And I just don't believe that. Hope you guys enjoyed this video. If you did, like, subscribe, drop a comment of a stock that you want me to take a look at. And I really appreciate the support. And I'll check you guys later. See ya.